Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Steve Sosnick, chief strategist over Interactive Brokers. We're going to take a look at some volatility term structure and the change in investor sentiment. Steve, it's great to see you as always. Welcome back to Trade Talks. And I think it's safe to say over the past week and a half, there certainly has been a change in what we're seeing in terms of volatility when it felt as if things were kind of, flattening out and evening there for a bit.
Oh, absolutely, Jill. This is a very interesting day to be talking vol. It was kind of fascinating. We really reversed almost on a dime in terms of sentiment. We were fairly complacent, as the chart shows. In this one, we're looking at vol Q as our volatility proxy, and we see that it's sort of meandered around the 25 level and then shot higher. Now, granted, vol Q has been a little stickier, a little more averse to coming down than VIX, which is more the broader SPX. I think that's somewhat of a change in sentiment away from some of the mega cap techs. Netflix, I think, scared some people, but it didn't do it immediately. And remember, of course, that vol Q and these other measures are looking at the market's best estimate of volatility over the coming 30 days. And we have no shortage of volatility-inducing events over the next 2 weeks, let alone 30 days. And it's amazing to me that as late as Thursday morning, we were sort of looking past them. Now, all of a sudden, people aren't. And that's a huge change in sentiment.
And Steve, you also noted that vol Q never got as low as VIX, but it was making higher lows during this trend.
Yes, and that does show that I think that does show me that there's been a bit more reticence since, let's say, the beginning of the year among traders, realizing that maybe the mega cap tech stocks, to which are such a huge contributor to NDX, there's some, I'm not going to say cracks among them, but even they're not invulnerable. Last earnings cycle, we had 2 of the 5 fangs really get kind of whacked. Those being Netflix and Meta, Facebook. And now, one of them has already been whacked, and the other 4 are to come this week. So I think in general, there's just been a little more risk aversion that we've seen among the traders who really follow the tech sector. And this is not to be super concerned about, but no stock is invulnerable, and I think that's where some of the risk aversion that we're seeing in vol Q, the lower highs amidst a rising, the higher lows amidst a rising trend, are where we're seeing this coming from.
And Steve, of course, it's normal to see short-term implied volatility move up into a company's earnings because earnings are in fact a volatility event.
Exactly. We always I hate to use Donald Rumsfeld's analogy, but it's the known unknowns. That he did put that term in there, and it's very apt. We know that there's something coming down the pipe, but we don't know what it is. We know that later this week, tomorrow we have Microsoft and Alphabet earnings. On Wednesday, we have Facebook earnings. On Thursday, we have Apple and Amazon. We know these earnings are coming. We don't know what they'll be, obviously, but we do know that there's a volatility associated with them. And traders tend to price in what the average volatility has been over the last few sets of moves. Obviously, that's more elevated in the case of Meta, Facebook than in some of the others, which responded well last earnings season. But yeah, so you do see the implied volatilities rise. Traders are a little reluctant to chase them initially because they get expensive in some cases, and nobody wants to be holding expensive options that are decaying quickly. So they wait till the last minute, and that's when you sort of see this little pop upwards in implied vols as we get to an earnings date with a major company.
Right. And Steve, I want to wrap up here with your last chart. Of course, term structure of implied volatility, which is something that you've been looking at as well, also signals that change in investor sentiment.
Oh, yeah. I mean, it's a dramatic move. We just a month ago, we were looking at a relatively normally sloped curve, sort of low in the front, higher in the back, gently sloping upwards, or a little bit of a convexity to it, but that was normal. As of a week or so ago, that started to change, and we started to flatten out, and then over the past couple of days, we've gone completely inverted. Now, one of the things about the inverted volatility curve of that nature is it's what I call one of the necessary but not sufficient conditions for a bottom. you kind of need to see that for the market to create a meaningful bottom, but it doesn't mean just because you see that the bottom is in place. And that's what remains to be seen with all these events between earnings week this week and coming forward, and the Fed meeting next week. There's no shortage of things for people to be obsessing about.
Yep, the market is always obsessing over something. And Steve, we look forward to talking to you in a couple of weeks. Of course, we'll be getting those April job numbers, of course, which will be key. And I'm sure we'll see a little bit of a movement in term structure there as well. Great to see you as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.